Hello, and thanks for jumping on this video. This video I want to cover how I trade SPY and SPX options, just to give you an overview of how to do it. I've been trading for about 15 years. I've worked in finance and I'm educated in finance. That doesn't mean anything, of course, as we all know, the markets do what they do. But I'm going to give you just a beginner strategy of trading options on SPY and SPX. Let's jump in. First of all, I need to give some basic information. If you're researching options, hopefully by now you know what calls and puts are. You might know what spreads are, but I'm going to cover some basic information on both. Calls, obviously, we want calls when we think the market is going to go up. So when we are bullish, we put on bullish trades, calls go up, and when we are bearish, we put on bear trades with puts. So puts are bearish, calls are bullish. Now I like to do spreads, so I will combine them, and I will also do short spreads depending on the market. Now each have their different benefits, but the main thing you're going to want to learn is that options are priced like loans. They are all overpriced. So I have here the S&P. I have S&P calls. I have S&P puts. Like we said, if you're bullish, you buy calls. If you're bearish, you tend to buy puts because they make money. However, I don't buy straight up options because you're paying some premium and it's like running uphill. When you buy an option, you're paying for funding. You're buying leverage and you're prepaying. So I think these are 1-day options, 0 day, they expire today. All of this premium is going to expire worthless. The in-the-money premium on the, let's say the calls, if you buy a call, some of it's going to melt off like an ice cube. It's going to melt off. So to avoid this, I use spreads. Most traders who trade options eventually learn how to use spreads. And spreads, it's when you combine two options to make like a little box, a box spread. So then let's jump over to the spreads. I already have it set up. I'm using the E-Trade website just to show the vertical spreads. They're called vertical spreads. All it means is I'm trading two options that are next to each other. So let's see, the market's 386. And if we look at the 386, 387, it's trading for about 50 cents. Now you can do the calls or the puts. It really doesn't matter. You just have to decide, are you bullish? Are you bearish? How do you want to structure it? The price for a $1 spread at 50 cents basically means that it's a 50-50 shot. If you're bullish, it might land in there, above there, or below there, but they're pricing it at 50 cents. And the further away from the at-the-money price, the cheaper the spread is going to be typically, if it's out of the money. If it goes in the money, it becomes more valuable. Hopefully those terms aren't too confusing, but let me jump into the chart and show you how I'm going to first decide which to do and then go grab a spread. So one way to trade options is to slap an indicator on there to help you figure out if the market is overbought or oversold. So in this case, I'm going to use the example of what I've been doing for the past couple weeks. You can trade 0 DTE 1 day, which I don't really prefer. I like to put them on for a week, for a month, for 100 days, just however much risk I want to put on. But I have to have an opinion. Now, it is useful to find out if the market is expensive or if it's cheap. It's the smart way to do it. And definitely I recommend you learn fundamental analysis. Once you have some form of opinion, you jump over to the technicals, and this is what the RSI is. The RSI is the relative strength indicator, and when the market is oversold, it's going to show a low reading below 50, and when the market is overbought, it'll show a high reading above 70, 80. And when it's turning is when I like to put on my spreads. So when the market reaches a level and it's not breaking out anymore, I have a Donchian channel, but it really doesn't matter. When it's making higher highs, that's an uptrend. When it starts to change the other way, that's weakening. But then if it recovers, it's back to an uptrend, and you see how this goes. All we're trying to figure out is a market really strong, or is it just chopping around sideways? Let me get rid of those. RSI is gonna give us an indication of how strong the market is. When it's doing these swings or turns, that's when I like to put on my trades. It doesn't guarantee I'm gonna win, but it's when I put them on. And I have rules for risk management, how to roll them. When you roll them, you close it and you move it out and give it more time. And I like to trade real small in the beginning, and if I want to, I can add to it. So let's say we're going to put on this spread from, let's say 2 weeks ago. We're going to start with one spread in this example. Let's go to the market. If I was trying to put on a bear spread, I'm going to sell calls, right? So I'm going to put on a little spread, and that's just how I'm going to draw it out. And since we're doing $1 spreads, I can do it at the money or just above the money, and I'll collect 50 cents or maybe 40 cents for that vertical call spread. Okay, this is the way I like to do it. You might do it differently, but this is what works for me. That way, if the market just goes sideways, I still make money. If the market goes down, of course I make money because it's a bear spread. And if the market goes up slowly, I still have a chance to make money, or I can roll it out. Okay, I can defend it. That's important because not all the trades are going to be winners. And this is why we choose to use call spreads, so we can defend and roll out a trade. I like to do not the 0 DTE. Sometimes I'll do it if the market is very strong. Like let's say if it's very strong and I want to do a very short-term spread, a 0 DTE is perfect. Generally, I like to give myself more time though. So you put on your spread. It either works or it doesn't. If it doesn't, I'm going to roll it out, and sometimes I might increase it a little bit. Now, if I had instead bought a put and the market goes against me, the option spread will, if I buy a put and the market goes against me, the option will decay. So this is why I don't want to pay for my option, because most of the time they just decay and they hurt you. So the spread is a better way to go. So that's selling a call. If I want to do a bullish trade, like let's say down here, I would sell a put spread also for 50 cents or whatever the spread is, but I want to try to get like at least a 1-to-1 ratio. If I want to have a higher probability, I would sell further away. In this case, a 50-50 spread. I like doing those. It's not for everyone. Some people prefer a different risk to reward ratio. I like 50 cents because if it goes against me, it can only go 50 cents against me per spread, and then I can roll or defend or whatever I need to do. But on the swings, we sell put spreads. On the highs, we sell call spreads. This is my strategy that I like to do. Obviously, I don't get it right all the time, but because I'm starting small, I can defend a trade like that by buying it back and putting it back out. If I have a loss, it'll be limited, and that seems to work for me. Right now, there's not a clear advantage, and because the market is trending down and it's near some previous supports, this is not somewhere I would be putting on spreads. I would wait, and I would actually avoid a lot of this market. Another thing you'll want to do, or I do, is I look at VIX. So this is a good time to bring the VIX into the conversation. When the VIX is low or high, that gives us useful information. VIX is the fear gauge. When the VIX is really high, that means premium's expensive. When the VIX is low, it means the market isn't moving as much. 2020, there was a huge spike. Options got very expensive, and then the market has been cooling off since then. Right now, we're getting an increase in volatility, which is useful information, but the VIX is no longer cheap and it's not quite expensive. So those are like the middle ranges. I try to avoid those. I don't like having the market fall on me, and I'd rather wait for an extreme. Another useful indicator that I like to use is the percentage of stocks above the 200-day moving average. That helps me with determining where the market is. Right now, the market went from overbought and really bullish to something else. So I don't know how long this will go, but I don't want to put on my put spreads until I get more information. But this was very useful to put on some short call spreads, as you can see. So after I put them on, I want to reduce my risk, and then I wait for a comfortable time to put them on. And I have multiple strategies, so I always have something to do. But for swing trading or short-term spread trading on SPY and SPX, this is what I'm looking at for putting on bear spreads or bull spreads on the S&P. You can do iron condors. You could do both. Like right now might be an okay time to put on both sides, both a short call spread and a short put spread. That is not what I'm going to do. I don't like having both sides when the market is starting to pick up volatility. And it's just easier for me to just pick a side and defend it. Another thing that I like to do is if I'm selling spreads in the S&P and the SPX, I'll also go find like good stocks that I like, and I'll sell puts there instead of in the S&P. I'm not going to point out the stocks that I like because it doesn't matter for this example, but if you're doing that, it's more of a long short strategy where you sell the index when it's high, but you buy quality growth companies that you're willing to own for a long time. I like that strategy for me instead of getting too focused on the S&P. I do naked puts. Sometimes I will do vertical spreads on the stocks that I like. But whenever I want to get bearish, I like getting bearish on the S&P because it's not a single stock. I think that's all I want to cover for this video. This is just a basic introduction to selling spreads. It can be 0 DTE, it can be a week, it can be 30 days. The recommended time is usually 30 to 45 days for selling options. But a lot of people are interested in those 0 DTEs, and I'm hoping to make some people more conservative with this video, that you don't have to gamble, because buying options is kind of a gamble. They can move a lot, but they're also designed to take your money. So I hope you found this useful. If you did, please like, comment, and consider subscribing. Cheers.